Welcome back, everybody. Let's get to our big interview for the hour. Legendary investor Ron Baron, who is the CEO and chairman of Baron Capital. And Ron, it's great to see you. You and I have been talking a lot over the last couple of months. Yeah, almost. I know. It's a little difficult with this new thing. But you and I have been talking a lot over the last couple of months. I know that you had been pretty optimistic about the market's eventual return. But you were a little reluctant to come on air and talk about it. Why don't you talk about why you've been optimistic and then maybe why you weren't willing to say something a little sooner?
Well, I wasn't willing to say something sooner because I didn't want to appear that I wasn't empathetic, that I didn't understand what was going on, that so many people were enduring so much pain and suffering, and I felt uncomfortable being optimistic in that kind of environment, and I am optimistic. So that was the problem I had. As far as coming on sooner. As far as the reasons I'm optimistic and forward-looking, when Joe was talking this morning, he spoke about small business people and how they are optimistic. Well, I was a small business person when I started this business in 1982, and when I came to Wall Street in 1970, I was not a business person. I was just in debt trying to pay my rent. And so I have optimistic genes in my nature. In addition to that, in the 1960s, 66 to 69, I was in law school at night, and I worked on a scholarship, and I worked in a patent office in the daytime. And I told my parents in 1969 that I've decided to become an investor. I wanted to be an analyst. And my parents said, that's the craziest thing I ever heard. That first you want to be a doctor, then you want to be a lawyer, now you want to drop out of law school with one semester to go, and you want to go to Wall Street. Don't you know about what's going to happen to the Depression? And so they were very negative. My uncle and my dad were both engineers for the Army. And my uncle said, well, before you make that decision, I need you to read this book. It's by Joseph Granville. And so he said, I insist that you read this book. And so I got the book, a big cocktail book about a daily strategy for making money in the stock market. And so I read the book. And what was shocking about it was that it said you're supposed to, this gets to the point about why I'm optimistic about investing. It gets to the point where he said, whenever there's really bad news, you're supposed to invest. You're supposed to invest when times are bad. That was the premise of this. And in fact, during my whole career, that's been the right way to go. When I started in 1968, the Dow Jones was, in 1969, the Dow was 1,000. It's now 27,000. The GDP of the country was 850 billion. It's now 21.5 trillion. So it's up 20 some odd times, about 7% a year compounded. And in that period of time, there's been 9/11, there's been a financial crisis, there's been COVID, there's been 1987 stock market crash. 1982, when I started Baron Capital, interest rates were 17 or 18% a year, 17, 18%, and I'm starting a business coming into a recession. And so this country has endured wars. And, Warren Buffett talks about this all the time, depressions, recessions, crises. But every single one of them that comes about, soon afterwards, we recover and we go on to new highs. And whenever they have these sort of events, what happens is the media gives great attention to terrific investors, and they all seem to come out and have negative views. I mean, it's amazing to me. They've been very, very successful, yet time after time, what they say is stocks are too risky in which to invest over and over again. And it's amazing, and I don't understand exactly how they have become so enormously successful, but they have. And so clearly they've taken risk that they feel is inappropriate for others to take, or they think that by sounding negative, that sounds smarter than if you just blithely roll along and think everything's fine. Well, I don't think things are fine. There's a lot of problems that we have, and they have to be solved, and they will be solved. And I'm not a politician or anything, but as I said, 1969, there were students in the streets about Vietnam and civil rights, and we were about to enter a recession, and stocks were going down. But again, the Dow Jones was 1,000, and is now 25 times higher, and the economy is 21, 22, 23 times. So I think that what's next is going to be faster growth in the next period of time than has been before. And what you would be worried about right now is whether or not we could conceivably tip into something much worse than a recession, a depression. And how am I assured that that's not going to happen? Well, we've just been through 10 years ago a learning experience, and we have learned from that. And this time around, we now have interest rates that are virtually zero. We have the government normally spends, $4 trillion a year. And what they did this time is that, and $2 trillion is mandated, it's Social Security, it's defense, and the other $2 trillion, the Congress negotiates for a year to spend $2 trillion. This time, fortunately for us, the president and the Congress came up with a bipartisan, way to address this, and in a couple of weeks, they spent $2 trillion. Amazing, and then they said there's more to come, and then extra programs, and then the Federal Reserve. The president has been pushing for lower interest rates, and what do you know? Interest rates are. Federal Reserve had a balance sheet of $2 trillion and went to 4. Then now the Federal Reserve is $4 trillion to 7, on the way to 10. So what that means is that the economy isn't any bigger. You just have more dollars out there, which makes all the savings that you have worth less. So every year, historically, the value of money keeps going down 3 or 4% a year. But this time, with all that money that's out there, then sooner or later, you're going to have, they will accomplish their objective of getting the value of money down. So the cost of money is low. The ability to invest is everywhere. And am I talking too much here? I can't get a reaction from you when
No, we can't see each other because we're not sitting next to each other. But Ron, I do have a couple of quick questions. First of all, I can vouch for you. You've been telling me this for the last several months. You have absolutely said all of these things all the way along. But have you put your money where your mouth was? Were you buying additional stocks? Did you sell any stocks? And the argument that you're making right now is basically one that you should never sell. I know you are a long-term holder. You hold most of your positions for more than a decade. But I also know that there are times when you have sold individual positions. Things like Under Armour come to mind. So what would cause you to sell in some of these situations, and what have you done with your money over the last several months?
Well, if the fundamentals change, then we sell. In times like this, when we have an opportunity to realize losses, because we're always buying, and if we have an opportunity to realize losses to shelter other gains and swap into something that is equivalent or close to or was higher than we could afford initially and got to a level that's more attractive now, then what we do is we take something off the table or sell it if the fundamentals are negative, and we realize a loss and go into something else or alternative. So the stock market right now, yesterday you had Stan Druckenmiller on, and he was talking about growth stocks versus value stocks, and he said that he missed the rise in growth stocks. That's where we have most of our money invested, and in value stocks, that's where he believes there's big opportunity. And for me, we have the area we've been hurt. So we're up on the year, probably 8 or 9 or 10%. We have a few funds that are over 17. They're up over 20%. High teens, up 20. So what do we do? About probably 20 some odd percent of our investments are in this travel and leisure area. That's in hotels. It could be in Vail Resorts. It could be Choice Hotels. It could be Hyatt. And it could be Penn National Gaming. So we have these investments, and what happened is that some of them have been amazingly punished. And when that was the case, with Hyatt Corporation, the stock went from 90 to in the 20s in a week or two, and because the algorithmic trading has given people a chance to panic. Bear markets used to take a real long time because it took people a long time to absorb the news and then to react and sell. Now you can sell overnight. Of course, you don't get the price you want, but you can sell overnight quickly. Sell me everything. And they sell everything, and they drive prices to levels that are unbelievable. In the case of Schwab, for example, they were telling me that the volumes that they saw in retail investors were 3.5 to 4 times what they had been in November. 3.5 to 4 times. And he said people are just selling everything, or investors selling everything. They're selling stocks, they're selling bonds, they're selling gold, they're selling everything. And to me, that emotional reaction is something, and when you see everything on television, those emotional reactions give opportunity. So for us, when Penn Gaming, for example, when the stock went down from 37 or 38, fell into below 10, and then at 17, they did a stock offering, and we were very excited about it because normally I won't go into detail, but they have a big opportunity as far as online gaming. So internet is enabling that, and also in sports betting. And they are going to be, when you read about DraftKings and you talk about FanDuel, those are gaming companies, sports betting, that they have to have licenses in the states in which Penn has casinos to be able to operate there. Anyway, they did an offering, 20 million shares, and we bought 2 million shares at 17. That stock is now 35. When Hyatt Corporation went down from 90 to in the 20s, it just went so fast, I didn't even see it. And trader calls me and says, by the way, Hyatt Corporation is down. And I said, wow, how would that happen? And it tells me, and I said, okay, buy me a couple 100,000 shares. And by the time I bought them, it was 40 or 38 or something, and now it's 65. When Activision, which is a company that we know and love and have been buying, and it didn't go down very much, but we continued to buy more Activision. So there are companies that when the Schwab we've been an investor in since 1992. Our original cost is less than $1 a share. When the stock had fallen from 50 down to mid-30s, we added to our position in Schwab. So what we've been doing all along is whenever we see, and that's an internet-enabled business, so whenever we have opportunities, we try to take advantage of them. And then on the other side, if something doesn't fit the mode anymore, parameters anymore, then we sell it, and especially sell it when we have a loss, because I would like to have that loss to shelter future gains that we generate in our portfolios.
Joe?
Yeah. So, Ron, your record it just speaks for itself, obviously. But I was thinking about it,
Thank you.
When I was a stockbroker for 10 years, you do learn something. You learn about when you actually make an investment, you have to 6 months or a year or 2 years, you're in there. You have to look back and you actually have a position where I don't think the media, that doesn't normally happen with people that are just covering it. So the point I was going to make was, as hard as it is to buy when there's blood on the streets, and it is really hard to do that, I think and so you should do the opposite of what you're feeling. How about when you got a stock that you bought at 30 that's at 400 or at 60, and then at 90, and then at 120? How about the old saying, Ron, no one ever went broke taking a profit? Sometimes it's just as hard to hang on or to buy more of something that's already tripled. That's the opposite of doing what the obvious thing is to do again. And I don't think anyone has done that better than you. You probably aren't going to sell your Tesla even though it's over 900, are you?
I would like to be able to get more money to buy more Tesla, actually. I think that what's going to happen in that stock is that when people were selling it short for the past 10 years, and the stock quadrupled, by the way, but for the first 9 years, it didn't change so much, go up and go down. But there was a good reason why people were selling it short. The reason was that it's very, very hard to start a car company, almost impossible. So you wouldn't dream that it would be possible to go out there and hire 50,000 employees and design cars and raise the capital that you need and have a brand that everyone knows, Tesla brand. My grandchildren, who are 6 and 8 years old, they know the Tesla brand. So basically, how is that? And they haven't spent a dime on advertising. How can you get a battery? They couldn't get batteries to go more than 100 miles on a charge before Tesla comes along, and now it's 400 miles, and it will be way more than that ultimately, and at a reasonable cost. So when we started off, I guess a few years before, it cost $100,000 for a battery. And then it could go a reasonable distance, 200 miles. And then it cost $30,000. Now it's less than 10, probably it's close to 5 before very long. And the cost of an internal combustion engine is $5,000 or $6,000 or $7,000. And a lot of places are going to ban them. There won't be any cars. But people didn't believe. And the only way you could possibly believe and to possibly come up with a good opinion is to go do the research yourself. You can't rely on other people telling you what to buy or what to sell. When you talk about not ever going broke by taking a profit, of course you don't go broke if you take a profit. On the other hand, you never get rich taking a profit either, because a good portion of what you realize you have to pay in taxes. So, and then you got to find something else that you like as well as what you already own and you know very well, so why would you do that?
Ron, what happens?
And so my thinking...
What happens to those other billionaires you were talking about that have made $1 billion and then seem to fall back into the trap that sort of novice investors sometimes fall in. What do you think really? Why haven't you ever gotten to that point where you decide, all right, I'm going to, because it does seem to happen a lot, and you do sound smart when you're negative for some reason.
Well, so why haven't I? Of course I have. I didn't start off to be a long-term investor. I became a long-term investor because of the disastrous mistakes I made by selling stocks early or by not buying stocks. The biggest mistake I ever made was in 1999. I would go visit Jeff Bezos. I visited him 2 or 3 times in a year. 2 or 3 times I visited him, trying to convince him, and I talked to him on the phone every month, trying to get him to purchase Sotheby's. So we bought Sotheby's at $20 a share, went to $40 a share because I thought you could take what they were doing to the internet. And I was trying to convince him that that was a good thing for him to own. He didn't buy that idea. And the stock, when the chairman of the company was indicted for price fixing with Christie's, went to prison, and the stock went from $40 Sotheby's to $10 where he sold it. So we lost half of our money. And I always thought that was the biggest mistake I ever made. The biggest mistake I ever made was seeing Jeff Bezos for a year up close and personal and not investing in it. How could I miss that? And Netflix. And so Netflix, we were investor in that when the market cap was $2 billion. It's now what, 200 billion? I don't know. And I didn't invest. Fortunately for me, some other guys in our office invested, but I didn't. And I became friendly with Reed. And when one opportunity that I had, the stock fell 30 or 40%. And I wasn't owning it. I had sold early. I had made my 30 or 40% and sold. And now the stock had gone a multiple of what I paid for it. And then it fell sharply because it had a pricing issue. And when they made that, then Reed called and said, Ron, this is your time. And I didn't even do that. And the stock went up who knows how much afterwards. And so I learned not to miss these things. And when I have something like a Tesla, I told you a long time ago that I thought that we would make 20 times our money in Tesla. So far, we've made 4 times. I now think we're going to make double or triple again over the next 5 years, and double or triple again over the next 5 years. I think there's 10 times more to go in Tesla before I have to even think about this, if we're right. And SpaceX. So we've just been investing. SpaceX is a private company. We've invested 180. We invested 130 million, I think. 125, 130 is now worth about 180. I think we're going to make 20 times in SpaceX. Over the next 10 years. That is an amazing opportunity as well. There was just something where you saw this rocket, first time private citizens have ever made a rocket go into space, launch it. This is government business. This isn't the private company. And we did it. So how did he do it? He did it because he figured out that the rockets that you send up are normally a couple or $300 million. That's what they cost, and they throw them away. The fuel cost to get them into space is $200,000, $300,000, and you throw away a rocket for $200 or $300 million. That's crazy. And so what Elon says is that, so I'll call him Elon instead of Elon Musk or instead of Mr. Musk. And what he said was, gee, why are we throwing away these rockets? Why don't we use them over and over again? This ship that we just saw go into space, that was something that had been used already 5 times. Got 5 more uses to come out of that one. The next rocket that we're going to be building, that SpaceX is going to be building, will be used, over and over and over again. So instead of doing it for hundreds of millions, they did it this time for 50 or 60. I don't remember exactly what. And the next one's going to be very, very small. So their innovation was sending a rocket up and bringing it back down and landing it just like they did in Star Wars. You land on the tail end, and it's like dropping, other people said, it's like dropping a pencil and expecting it to land on the eraser and stand up still. So first couple times they tried it, didn't work, then they got it to work. And so that gives them a huge competitive advantage. Now the opportunity that they have is that they will have these satellites that they're launching now, thousands, tens of thousands of satellites, and they're going to give you internet communications from satellites. It's going to start this fall. And the opportunity they have, instead of a satellite that costs $50 million, $100 million, or something less than that, our guy can have very, very inexpensive satellites, a lot of them, and they're going to be able, because of that, going to be able to have them last for some shorter period of time and keep replacing them and keep having, up-to-date technology in these satellites all the time and have an enormously profitable business in SpaceX. There's one point I want to also make, that Elon went to Russia 19 years ago because he had these ideas about getting to Mars and getting into space again, and he wanted to buy a rocket from the Russians. And ultimately, after negotiating, they said, no, we're not going to sell you one. And he said, at the end of the day, with his scientists visiting him, he says, it's all right. I think we can do this ourselves. And then they said to him, what are you going to do with a slingshot? And then afterwards, they launched this rocket, and they got the capsule to the space station. At 17,500 miles an hour in space, it autonomously connected with the space station. And so afterwards, he's on a program, he's being interviewed, and he says, so how'd you like that slingshot? And the reason for that was the reference to what he had, the Russians had told him 19 years ago, you're going to get up there on a slingshot? And so, yeah, he did.
It's perfect. How do you like them apples, right? Hey, Ron, we are almost out of time, but I want to circle back to something you said a couple of minutes ago when you were talking about Charles Schwab. You own a stake in that company. You said that they told you that their investors, retail investors, the volume went up by 3.5, 4 times during the panic. And that particularly concerns me because that means the people who got sucked into this are the mom and pop retail investors who now have sold at the lows and watched stocks come back up. Is there anything that you can tell them to figure out how to weather this? Anything that you can kind of pass on?
Well, there was something in the paper yesterday that said that 32% of people were bullish. That's institutional investors. So how can you expect retail investors to be more bullish than they are? And then last week in Barron's, they reported that there were $9 billion of redemptions that month. And so the only thing I can think of is that what people should do is what Buffett says, either find a good fund that beats the markets, and our funds, 98.6% beat the markets, but either find that or, just for yourself, just buy index funds and just buy them regularly every month, and don't ever be worried about. I tell people, don't be afraid. And what's going to happen is you're going to make 7% your money over the long term, and you should also root sometimes the market to go down, and then you get to buy at better prices. Could I give you one more thought before? Sure. My idea is it's very, very hard for people to do this themselves. They should get a professional advisor, and they should invest in mutual funds or index funds or ETF, something, but they shouldn't do it on their own. They can't possibly react because institutional investors don't get it right all the time. They should have someone else try to do it for them who studies this, just like you wouldn't want them to be, me to be your dentist. I wouldn't want you to manage money for me. So let me just give you one other thing, point, that in Tisch and also Jay Pritzker, they became wealthy in the 1950s and 1960s after they realized that the interstate highway that President Eisenhower had built was going to enable businesses like McDonald's and Disney and Holiday Inns to become great growth companies. And they went out and they bought property all around, in Florida, in California, in Orlando, that would enable them to make great deals of money from building properties where there hadn't been properties before they became resorts. And that's what they did. So the interstate highway and the airlines were enablers. The Internet is now an enabler. So the Internet is what's going to make many businesses become very, very successful. And companies that can take advantage of the Internet, whether it's a Charles Schwab, whether it's a Tesla having a connected car, whether it's Activision with their games, whether it's MSCI, that you need their indexes, whether it's Spotify, whether it's Shopify. These are companies. So 80% of our business is invested in companies that are growth companies, and 20% or so odd, that's the area that got really hurt. That's the area that I think is going to take 2 or 3 years to get back to where they were in November and February of this past year. So 2 or 3 years to recover, and they're selling maybe half price, maybe down 30, 40%. That's where you're going to get in the next 3 or 4 years. You get back to where you were. The other growth companies, they'll keep growing. Those cyclical companies, they'll get back to where they were. And that's the big opportunity in the short term, is investing in some of those companies that have been hurt. And the other side is keeping those investments in growth companies that, maybe they're a little bit high right now, or maybe they're not, but they are going to be the opportunity in the future. In Tesla, that's going to be 2,000 or 3,000 in 5 years, and multiple of that over the next 5 years.
Hey, Ron, I want to thank you so much for your time. It's really good talking to you, as always. We appreciate it, and we will talk to you again soon.